Today we're going to be talking about how to review a tax return, specifically focusing on how to review a Form 1040 individual tax return. Well, let's talk about why we're really trying to review a return. What is it that we're looking for? Well, first of all, we're trying to make sure the return's correct. But there's more really to it than that. We've got to identify issues that are in the return and identify and address risks that may be buried in that return. And of course, the whole idea of minimizing tax by finding the things that need to be done to make that tax return correct, that's certainly an objective. We want to avoid audit. We want to do some tax planning. Oftentimes, when we're looking at a return after it's been completed, we can see things that could be done perhaps to reduce taxes for the client in the upcoming year. We want to improve client relationships. Nothing's worse than giving a half-done return or return that's done incorrectly or sloppily to a client. So we want to find whether there's something wrong with this return, correct it, make sure that this return is produced in a professional and accurate manner so that the client will be impressed with the work that we've done. Really, when it comes down to it, we've got two functions here in reviewing. We want to protect ourselves in terms of quality control and doing a good return, and also we want to protect that client, making sure that they're getting a quality product that's been given the proper amount of care and due consideration. Well, who actually is the reviewer? Well, the ultimate reviewer, of course, is the Internal Revenue Service. But before that, we're going to actually look at the client. What do we want the client to do when they look at that return? Now, some clients want to just close their eyes and sign on an 8879 and have you file a return. We think that's a very bad idea. It's very important that our clients become involved in this review process. In fact, in our engagement letter in our firm, we have the statement that we make mistakes. That sounds alarming, but we're only human. We do make mistakes. And so we want that client to be looking at that return in addition to ourselves to make sure that they don't catch something. And very often times they do catch things like, one client came in and told us they forgot to tell us they'd had a new baby. Another one came in and said, gee, you haven't changed my address. Well, gee, we looked at the organizer that they had completed, and they put their old address there. As luck would have it, at least the client caught that. So sometimes the client is the ultimate reviewer of the return. We think that having a client review is a very important part of the tax return process. In fact, in our firm, what we do is have the client come in, and when they pick up a return, we have a staff member sit with them and go through the basics of the return so that they get an idea of what's in the return. After all, they're going to be signing on that return saying, under penalties of perjury, that they think it's correct. It's important that a client review a return because that gives them ownership of it. Many times clients come by and they just bring a folder full of papers and they want to just drop it off and run. They really don't want to take ownership of that return. But we think it's important that through the review process and having them just look at the return, maybe it's not an in-depth review, but at least something where they understand the contents and how the return was prepared, that gives them ownership of the return. It's very good for client relations. We've found that discussing the return with the client leads to discussions about tax planning and many times to other engagements to figure out how to help the client minimize their taxes. So we encourage client reviews. We use it as a tool for engagement with that client and basically find that it's an important part of establishing a relationship or a partnership with that client in the process of preparing a return. Well, let's talk about the firm reviewer. What is the firm reviewer trying to do? Well, they have certain objectives. We want to make sure that our return has been well prepared, that it's defensible. Any tax positions we've taken on the return are defensible, that it's tax minimized. We want to have a production system so that our returns are prepared with uniform quality, that there is in our own firm some form of internal control. We also see reviewing as a staff development and education process, because the preparer will learn from the reviewer. The reviewer may learn from the preparer. And of course, in the end, the whole idea of having a well-prepared, well-reviewed return is a happy, satisfied, and evangelistic client, the kind of client that will send you more of the kinds of clients you want to have. Tax quality control really begins with the client. There are some returns that just can't be prepared. And so at the outset, it's the preparer's responsibility when they're faced with doing an interview with a client or looking at the information that a client is presenting to determine whether or not a return really can be prepared. And, the preparer really isn't the arbiter of fact. We're not there to determine whether things are true or not true. But if the documentation and the support and the kinds of things that a client presents to you are so shaky, sometimes the very best thing we can do is tell that client that we can't prepare that return. When we start working on doing a return, it's important that we have a system, some sort of system that a preparer runs through in terms of preparing the return. This process is something that should be documented, and we need to get a trail of evidence and documentation, the fact that they've asked the right questions, and we find the best way to do that is to use the organizer, to run through the organizer, to make notes on the organizer, to highlight things in the organizer. We find that notes to the return are very important. In fact, in our firm, one of the things we do is after a preparer has gone through a return, after an interviewer has spoken with a client, the preparer has prepared the return, we write a little memo on the top before it goes to the reviewer, which summarizes the basic issues that the preparer or the interviewer found in dealing with this client's information. So these notes are oftentimes a key or a trigger for things to be looking at in the return. We want to look for support that backs up most of the important figures that are shown on the return. Now, many times clients come in and they're a little bit hazy about some of these figures, and we don't want to have to go back and start auditing their auto log, or we sometimes call it the mythical auto log. We want to have to go back and try to look at all the receipts. What we want our client to do is come to us at least prepared to the point where they have sufficient documentation. And we'll ask them whether they have it, but we don't actually need to go through and audit all of that support. Well, there's some imperatives we need to talk about in doing a review, and one of the imperatives is that we be systematic. In other words, we can't just be helter-skelter in this review. We're presented with some information that's been entered by an interviewer or a preparer. We're going to look at it in a very systematic fashion to see whether or not it's accurate, it's been done correctly. We want to be efficient in our review, too. I mean, it's possible to suck up enormous amounts of time and basically go through a return, look at all the details, and miss the 800-pound elephant sitting in the room. In other words, oftentimes things that are important in a return can be missed if we're not doing an efficient kind of return. We want to look for evidence. In other words, where did this return come from? What sort of backup do we have for it, and what kinds of things have our clients represented to us that they have to support the figures that show up on the return? We want our return review to be comprehensive. In other words, we want to identify what the preparer did and maybe didn't do, what the client did, and what maybe they may have missed. And a comprehensive review will uncover the kinds of things that are important in our tax return preparation. And finally, of course, we're looking for a documented review. We want to make sure that our work papers reflect the fact that this return has had the proper amount of scrutiny, that we've looked at it and we've determined that we've done our work appropriately. Well, where do we really begin in the review? We think that it really begins with the preparer and the client. And central to that is the organizer. In fact, every single return that we do, we start with the organizer. We find that's an important documentary tool. It asks all the right questions and ensures that we're looking in all the right areas. We want to look at the data. We want to make sure it's organized and sorted and noted. Nothing's worse than giving a reviewer a pile of stuff and, well, part of it's relevant and part of it isn't. We don't care if they've got laundry receipts in there or lotto tickets. We're interested, of course, unless they're the winning numbers, of course, we're interested in finding the information in the right order. And so this whole process of doing a review begins with the preparer and the client getting their stuff together. And the preparer should shift through it and make sure that the stuff is organized in the same organization as the organizer, which should then lead to our return itself. We also want to have a permanent file, which includes notes and schedules and annotations that carry over from one year to another. I'll give you an example of this. Well, we have a client the other day came in and they get a distribution from an IRA. Well, ordinarily a distribution from an IRA, a regular type IRA, is a taxable event. Well, in this particular IRA, the client had rolled over a particular kind of tax-free benefit that had accrued as a part of employment with the school district, where initially the amounts that were deferred for federal purposes but not for state purposes. Well, now they're taking it out and they're taking both tax-free and taxable amounts out of this IRA. And of course the 1099-R that they receive, the form showing the distribution, is not at all entirely taxable for federal. Well, the trustee doesn't know this, so we have to do a calculation. No one would know this unless they knew the history, and the only way they're going to know the history is to go through the permanent file. So we look for notes and schedules and annotations in that permanent file that will reflect on the current year. Which brings the whole thing up about being familiar with our client and the facts, issues, and the return, and of course, understanding tax law. Well, we understand tax code. We all know it's very convoluted, and sometimes things in the tax code are so complex that, well, they apply differently in different client situations. And so our permanent file can help us with that sort of review. There are a lot of different kinds of approaches to reviewing a return. We've identified 4 that we think are important, or at least the primary sorts of reviews that one would do. First one's a content review, where we're actually going to look at the content. Then an issues review. Finally, there are 2 approaches to doing a review. One top-down, going from the top level down to the very basic details, and the other from the bottom up. So let's look at each one of these. Let's look at a content review first. Well, in a content review, our objective is to focus on the content. In other words, testing individual balances. And we might not test all of them. We're going to select certain balances and then trace that back to the detail or supporting documentation. So, for example, we might look at the dividends and make sure that the total there agrees with all the 1099s, or that the total of all the W-2s agrees with the salaries. We might look at cash donations and make sure that the total is equal to the total from source documents. Same thing with child care credits. Make sure that we, in fact, have some 1099s or information from that that's properly reflected. Now, the problem with a content review is that we're really only seeing what's there, and the testing is somewhat mechanical. Additionally, we're kind of walking in the same path as the preparer, and because of that, we're only testing a sample of the numbers. So sometimes it's better to look at the return from an issues review. Well, in an issues review, what we're looking for is the overall theme of the return. In other words, what's the sort of things that's happening in this return, and what's important that we focus on as issues that could affect the determination of the proper amount of tax liability. So we might be looking at a return that has lots of capital gain, or maybe it's a business return, or maybe there's some issues with losses here. So we're trying to identify the issues that affect the taxpayer, such as children, education, health care credit, that sort of stuff, and then determine how they've been dealt with in the return. And then we'll look to see whether the return itself actually raises certain issues. You know, there might be some big sore thumbs on the return. There might be amounts which just look out of place, or maybe the amounts are outside of the sorts of percentages that one would look for in a return. Finally, we come to the 2 ways of looking at a return, a top-down and a bottom-up. Now, the top-down review, sometimes called the 10,000-foot review level. We're just looking at what this return's all about, and what are the areas that need attention, and do the results on the return look reasonable? We might actually just look at the return and say, well, this looks like a reasonably well-prepared return, and that's it, and go forward. We might want to take the results and compare them to certain averages. For example, what's the percentage of charitable contributions to the AGI, or what is the percentage of capital gains to the average returns for that sort of income level? We're going to mostly do, I guess, what we look at as a qualitative review. Now let's go down a little bit further and maybe do only a 100-foot level. We might take the return that we've just prepared and compare it to last year's. We would look for new issues, or maybe issues that were shown in last year's return that didn't appear in this issue. We'd look to the numbers and see how they're compared to an average return. We might look for things that stick out at comparison between years. Those are the things we would look for in a top-down review. Well, there's some problems that occur in this top-down review. I mean, really, it's kind of general when you think about it, and oftentimes the mistakes are in the details. It's real easy to get sucked into doing some fuzzy logic, and it's hard to get away from this comparison between this year and last year and remember that each year stands on its own, and maybe this year is completely different than last year. You know, sometimes when we look at last year's and then look at this year's and just kind of carry it forward, we have kind of a preconception of what the return should look like, and this can lead to a problem. Well, the final way of looking at a return is to do the bottom-up review. And unfortunately, this is what most accountants do first, and it's unfortunate because this is the wrong way to look at doing a return. This thing can really suck up a lot of time. You know, we're basically recreating the return. you had to use this approach very sparingly. When we do a bottom-up return, we take all the source documents and we trace them back to the return, and we see whether or not they're properly reflected. We go through the organizer and make sure that it's reflected accurately in the return. And basically, we start from all this source and we trace right to the return. We determine that everything is there, and we might catch a footing error, an adding error. We might look to see that whether or not the materials have been handled properly or coded properly in the return. But did we really catch the obvious mistakes? Do we see the not-so-obvious implications of what was there? Perhaps there was tax-free or treasury interest that was buried in the mutual funds and we didn't see it. Maybe there's the availability of healthcare credits, or perhaps there's a deduction or a credit for education. Even things like the child care credit that maybe are posted on a W-2. So there are a lot of problems with the bottom-up. We really are recreating the wheel, and we're following that same rut as the preparer, and so we might miss exactly the same things. So when looking at these 4 different kinds of ways to review a return, content, issues, top-down and bottom-up, which one's really best? Well, in the end, the answer is that they're all really very important. And we probably want to take a bit of each sort of review process and use it in our comprehensive way of looking at a return. Well, in that top-down review, we really want to do that first. We want to start with a quick review of the prior return and find out the profile of the client and what issues arose in the prior return that may manifest themselves in this year's return. We'll look for things like carryovers and look for notes in the permanent file. Just get a good idea of what this client has been through in prior years and how this may play out in the current year. We're going to compare the prior year to the current year and see the difference. Look for income sources and income amounts, deduction, and where those are, and different kinds of credits. Well, we'll start by looking at the organizer. Was it complete? Here's where we find a big problem, because many times interviewers, when going through an organizer with a client, will leave things blank. They don't fill in the organizer, or they gloss over things. And very often we see Sally, S-A-L-Y, same as last year. Really? Is that true? And those are the things that we need to question in looking at a organizer. We want to look for the support for the obvious stuff. And then we want to go back to the return. What sticks out compared to the organizer? Are there things that were mentioned in the organizer that maybe don't manifest themselves as expected in the return? Are there unusual numbers? We might look at the return by doing a zone review. The information that identifies the client as one zone, then the income, the adjustments, the deductions, the credits, see which things are there. Well, the baseline question is whether we need to be filing a return at all. And of course, in the materials here, you'll see a basic chart that shows whether or not you really need to file a return. Secondly, we ought to be going through this zone review, starting at the very top of the return and working our way down. And as you can see, our return really falls into several distinct categories. So we focus on the top lines and identify that, in fact, the address and the names are correct, the Social Security numbers are correct, and the filing status is correct. Did we, in fact, select the right filing status? Was head of household available? Is this person a qualifying widower? Remember that goes for 2 years after the death of the spouse if there's a qualifying dependent in the house. We also should look at married filing separately. Now, some tax programs do this automatically, but, it's not as obvious as it looks. Because if the information hasn't been coded correctly in the tax return program, it'll have a hard time doing that calculation. So we need to identify the income as being the spouse's or which spouse it belongs to. We need to identify how assets are held, whether they're in taxpayer, spouse, or jointly held, in order for that computer program to do an accurate calculation. In focusing on dependents, we want to make sure, well, where are they? If they're over 19, are they in school? If they're a child that's let's say a full-time student, did they provide over half their own support? Maybe they belong to another taxpayer. Are we sure we have correct Social Security numbers for all of them? And if in the situation in which we have separated taxpayers or with a child that might be one or the others, we might have to look back at the rules and see what the issues are with respect to the tiebreaker rules or even the divorce issues with Form 8332 the release of exemption. When we're dealing with qualifying relatives, and household and income support tests have to be looked at it. And finally, we get down to this under the $3,900 income level. We have to look at whether or not we've included or excluded non-taxable Social Security in that calculation. So oftentimes there are dependents that may be hiding out there that haven't been considered. Maybe the interviewer didn't ask the question of whether a parent or a grandparent is receiving support. And there might even be a situation where there's a possibility for a partial support agreement where a grandparent is shared amongst family members under a multiple support agreement. We'll look for dependents and determine whether or not, if they're between 18 and 24, they're involved in post-secondary education. Well, that brings up that whole American Opportunities Tax Credit, that $2,500 credit. It's for the first 4 years of education. But remember, that thing phases out at about $180,000 of income married filing joint. But there's always the lifetime learning credit. Maybe there's a tuition deduction. There might even be student loan interest. Or perhaps some of the funds have come from EE savings bonds, and they might be interest tax-free if, in fact, they were redeemed for education. All good questions to be asking when we're looking at that. Next, we'll focus on income and look at the various sources of income. We'll want to look at the W-2s very carefully. And oftentimes there are some things on W-2s that can cause some real problems. Look at the Box 12 and also Box 13. There's some important information there. Many times interviewers or preparers in their rush will fail to enter the information that's shown on the W-2s in the completeness. And here on the screen you see some of the codes for Box 12 that are very important. For example, a Code D, which indicates elected deferrals to a 401k. We've had instances in which clients worked for several employers during the year and maxed out the amount of the 401k contributions on each of the W-2s, which of course leads to a situation in which they've overfunded, and could be a possible excise tax penalty unless they remove those amounts and reclassify them. We need to look for Code P for excludable moving expense reimbursements, which will indicate the need for a Form 3903, the moving expense. We want to look for a Code T for adoption benefits. And here's a big one, Code W for employer contributions to a cafeteria plan to an HSA, because that will trigger the possibility that they've had distributions that we have to account for. And of course, finally, we can look at Code V, which indicates that there's been income from the exercise of a non-statutory stock option, a very common occurrence and something we need to be aware of because it has a big implication in that tax return. So we'll look for these different kinds of codes. Remember, if we find a Code A or a Code B, we may have some additional Social Security tax we have to deal with. If we see a Code D, E, F, G, H, S, AA, or BB, well, then we're possibly dealing with a credit for qualified retirement saving contributions, that Form 8880. Remember, of course, that thing phases out when we're talking about over $60,000 in married filing jointly. We talked about the Code V, but there's other codes that are important too, like the Code J for non-taxable sick pay, or Code L for substantiated employee business expenses. And if we see that, we may have to look at a Form 2106. Code P, we'll want to see a Form 3903. All right, so there's different kinds of these codes, and they do, in fact, impact the way the returns are prepared. And a lot of stuff that we see right on the W-2 floating through the rest of the return. Well, dealing with the wages is only one part, of course. Now we get down to all of the other sorts of income. Let's talk about interest income. Sometimes they've got things that are from insurance companies and they're showing dividends. Well, those are really taxable as interest. Or maybe there's some nominee interest. Very often we see situations in which clients have set up savings accounts for their children, their minor children, and so they put their own Social Security numbers on those accounts. So we'll want to report that interest income and then deduct it as nominee interest. There may be some below market interest loans that have been made, perhaps between an employee and his company, or between a business, or between family members for something, in which case we may have to impute interest on the below market interest loans. And of course, to do that, we use something called the AFR, the applicable federal rate, and those rates are published very regularly by the Internal Revenue Service. Well, one thing we may see in a return is something called OID, which is called Original Issue Discount. Well, as you know, Original Issue Discount reflects the difference between what a bond par value is and what it's actually sold for. So bonds are priced, let's say a $1,000 bond sells for $900. Well, there's $100 of discount there, and that's amortized over a period of years, and the discount will be, the amortization of the discount over the period of the bond's issuance will be reflected in a 1099 OID. Well, there's only one problem with that. The 1099 OID only applies to the original bondholder. So let's take, for example, a situation in which a bond that had a par value of $1,000 was issued for $900. Later on, interest rates declined, and so as a result of that, the bond would increase in value, and our client purchased the bond for $1,100, actually having a premium. So now we have a 1099 OID, which our client's going to receive, showing this $100 allocated out over the life of the bond. But really, we didn't have a discount. We had a premium. As you can see, the 1099 OID only applies to the original holder of the bond. And so if you get a 1099 OID, you're going to have to ask your client about when they acquired these bonds and determine whether or not there is, in fact, instead of a discount, a premium to be amortized, or perhaps a discount amount different from the amount that's reflected in the 1099 OID. So again, the importance of an OID can't be overstressed for those that hold bonds for long periods of time. And so we have to determine the client's discount or premium for each individual bond. And so if it is a premium, we can amortize it and actually offset it to the interest income. When we're looking at interest income, well, I want to ask our clients about old savings bonds. For example, Series E, H, EE, HH, and I bonds, because these bonds only earn interest for a set period of time. And as you can see on the screen here, this varies between 20 and 40 years. So we want to look to determine whether or not a client has some of these. It's always a good thing to ask them. There might be some bonds they've not done anything with, held on for a while, and maybe these things need to be cashed in because they're not earning interest any longer. When we get to looking at dividends, remember that whether something is qualified versus regular does depend upon a holding period. And sometimes the brokers will do this incorrectly. If you haven't held a stock for 60 days, the dividends that you receive, even though they might otherwise be qualified dividends for the lower rate, will be considered to be regular income. Sometimes a client will receive something called a 1099 PATR, which is a patronage dividend. Well, they really don't belong on Schedule B. These aren't real dividends per se. They go over on a Schedule F or a Schedule C. Moving right along, there could be things hiding on the brokerage or mutual fund 1099s. Things like municipal bond interest or treasury interest, or perhaps foreign taxes paid or state-specific interest. On some brokerage or mutual fund 1099s, these are well identified. In others, well, it's kind of difficult to see. In fact, we saw a 1099 from one discount brokerage where none of this information was revealed. And for the underlying mutual fund holdings included in the account, you had to go back to the individual mutual fund website to find the information. And as a result of that, it took a long time to complete the return. Fortunately, there was a lot of municipal bond interest and treasury interest that was found in those individual mutual funds. The cost of doing that additional research just about offset the tax savings. At the bottom of Schedule B are the important questions 7 and 8. It's important that a client answer them correctly. Now, in prior years, these questions were a lot more summary in nature than they are now, and they point to the necessity of filing a FinCEN Form 114, which is a report of a foreign bank account or financial account. Well, some of the information that's shown there in the question, they indicate like a bank account or securities account or brokerage account, but they don't really focus on all of the situations in which a FinCEN 114 might be required. So it's incumbent upon a preparer to know about the FinCEN 114 and what sorts of foreign assets qualify for inclusion and the requirements of filing the form. So important that our preparers have addressed those issues. We actually have a few questions in the tax organizer to clarify those issues to make sure that these things are answered correctly. When it comes to foreign pensions, that's a real issue in reporting for U.S. income taxes. As you know, if you're a U.S. citizen or a resident of the United States, you're taxed on your worldwide income. Well, foreign pensions or deferred accounts in other lands are not deferred or necessarily tax-free in the United States. And so because these things aren't recognized by tax law except in certain circumstances, U.S. residents or citizens who have these accounts are taxed not only in the amounts that are deferred by contributions, but also on any income earned by the accounts, even though the accounts are inside a pension. And so it's incumbent upon them to file what's known as a Form 3520, an annual return to report transactions with foreign trusts. In addition, they may be required to file a Form 3520A. Now, for Canada, there's a specific situation where Canada has something like an IRA account. It's called an RRSP. But U.S. residents who have balances in these accounts are taxed on the income that's earned inside them, unless they have made an election. And the election would have been made on a Form 8891, which is on the screen. Well, many times Canadian citizens come to live in the United States and they don't realize that because they're a U.S. resident that they're going to be taxed on the income that's earned inside this deferred account. And you can see how that's done right here on line 7A, 7B. And even the undistributed earnings of the plan during the year on line number 10. But there is an election, as seen on line 6A and B, where one can make an election to not have that taxed. Now, in the past, a lot of U.S. residents and citizens who had these RRSP accounts just didn't report this income. They assumed they were like an IRA. Well, the U.S.-Canada tax treaty allows that if you make the election, but they weren't doing it. Well, Revenue 2014-55 changes everything now, and so hopefully this will not become a problem anymore. You don't need to file the Form 8891 anymore. You can make the election automatically to have it deferred and have the Canadian RRSP account treated just like a U.S. IRA. However, if a client has reported the income in the past and paid tax on it, you got to continue to do so. And you can't make the election to not do that without IRS permission. So RevProc 2014-55 makes this old Form 8891 obsolete for any new filing. However, if you have been paying the tax, you're going to have to continue to do so. This whole issue is a big relief for many preparers who hadn't been filing the 8891. When we talk about foreign accounts, the three areas of concern really are the Part 3 of the Schedule B, those questions. And then there's also the FinCEN Form 114, which is also known as an F-bar. This thing is not part of the income tax return, but is actually due June 30th, and it has to be filed online. And it's due for all those with accounts over $10,000 at any time during the year. There's also this Form 8938, the Statement of Specified Foreign Assets, which is filed with the tax return. But the differences between these two really get down to whether the amounts in the accounts. The FinCEN 114 has a filing limitation that is at $10,000, whereas the 8938 has a much higher level, as you can see on the screen. Between 100 to 150 is about the level of filing. If you don't have that much in foreign assets, you're not required to file the Form 8938. And really what it's looking for is just trying to make sure that you report the income. Well, what kinds of assets need to be reported on the FinCEN 114? Well, we know that foreign bank accounts, it's very obvious, those are listed in the question itself. But there are also investments that aren't held in a financial account. Things like stocks and securities that weren't issued by a U.S. person or U.S. company, or any other interest in a foreign entity, which could be a partnership or a trust, and any financial instrument or contract where the issuer is not a U.S. person or a U.S. counterparty, such as an option. So some examples would be stocks in a foreign corporation that were held in a foreign brokerage or held individually, notes or bonds by a foreign corporation, even things like interest rate swaps or derivatives, or even things like options. And these options could be very simple options. They could be on a commodity, such as grain, in which a foreign party is a part of this. It could be an interest in a foreign partnership, or even a foreign retirement account, something different than a Social Security or regular defined benefit account. Now, there's certain things that you don't have to report. You don't have to report U.S. mutual funds that have foreign stocks in them or any accounts that are maintained by a U.S. institution. You also don't have to report an account at a U.S. branch of a foreign institution. And nor do you have to report typical foreign Social Security sorts of things, where it's like the Canadian pension that's provided by an employer or the government, but something like an RRSP or something similar to a 401k, where there's a defined contribution balance. That must be reported. You don't have to report things like tangible assets or precious metals or real estate in your name, but if they're part of a corporation or a partnership, they must be reported. Now, one of the problems that we've had in our practice are clients that own real estate in Mexico on the coast. Well, you could have a retirement condo down in Cabo San Lucas, and that particular condo is held in fee simple interest. It's held in a Mexican land trust because no foreign nationals can own land in Mexico on the coast. They have to be held in a trust. Well, there's a revenue procedure in 2013 that says those don't have to be reported on a FinCEN 114. However, if that property is leased or rented, then it becomes subject to reporting on the FinCEN 114. And here we see a copy of the FinCEN 114. This is done online. Sometimes your tax software will file this thing, but it's very important to fill it in and correctly make it submitted. And it must be filed online no later than June 30th. Walking down our income statement, we come down to some of the other income issues, things like tax refunds. Sometimes it's important to look at those things a little more deeply. They may end up not being taxable, or pensions or annuities. Part of these may not be taxable. There is something called the general calculation that may need to be done. IRA distributions. They can be rolled over within 60 days, and there are certain exceptions to the 10% penalty, as you see here. But you have to look at these things, and there's some new tax law case about rollovers. With respect to IRA distributions, there's that issue of when you reach 70 and a half, how there's a required minimum distribution, which is based on a uniform life table. And we've shown the table here on how this is actually calculated. Make sure it's done right because there's a 50% penalty if it's not taken. There is, however, the ability to ask for a waiver if you need it. For Roth IRA distributions, distributions are first made out of contributions, and these are tax-free at any time. But the earnings that's been earned in that Roth IRA may be subject to a penalty if it's a premature distribution. Generally, the Roth has to be at least 5 years old, and the taxpayer has to be 59 and a half, disabled, or so. It's important to look at these things and see whether or not they're subject to a penalty. That penalty is, of course, 10%, the same as the penalty for premature distributions of a regular IRA. Now, we have something called a non-deductible IRA. It's important that a Form 8606 is filed when contributions to non-deductible IRAs is made, so that the IRS is notified that these are non-deductible IRAs, and later on when they're taken out, the principal amounts will not be taxed. Here's a strategy using non-deductible IRAs. You can make a contribution to a non-deductible IRA no matter what your income level, and then it's possible to roll this over almost immediately to a Roth. You see, to make a Roth contribution, you have to have income of less than $188,000 married filing joint, or $127,000 if you're single. So maybe a client hasn't thought about this. It's an ideal way to get money into a Roth IRA. Make a non-deductible IRA contribution and then instantly roll it over into a Roth IRA. In that way, the income that's earned inside that Roth IRA will never be subject to taxation. When you receive a 1099-R, of course you're going to look at Box 1 and Box 2A. There's a lot more important information on that 1099-A. And be careful. Sometimes the amount that's shown as taxable isn't really correct. There are situations in which the 1099-R is incomplete or incorrect. And so you may wish to apply the simplified method to calculate out how much of the payment from an annuity or a pension is subject to income tax. And we've reproduced here the simplified method. Well, we've worked our way down through the income statement part of the tax return. We've seen there's some issues here with respect to IRA distributions and pensions and annuities. Also be alert for the presence of alimony that's received. It's important that that be properly reflected. Now let's take a look at Schedule C, the profit or loss from a business. Well, first of all, make sure that the principal business or profession is adequately described. Make sure you enter the proper code from the instructions. Avoid using code 999999. Also, look at the employer ID number, the EIN number. If the business doesn't have one, don't use the Social Security number there. And finally, we come to questions number I and J about the 1099s. Make sure those questions are adequately addressed. On the income statement itself, make sure all gross receipts are properly reflected. It's oftentimes a good idea to make sure that your client brings you their bank statements, and maybe you'll do a total off of the deposits and reconcile that. That proof of cash approach is what an IRS auditor is going to do, so not a bad idea if you do it yourself ahead of time. Gross profit is oftentimes measured as a percentage of sales, and that gross profit ratio is used by auditors to determine whether or not there's something wrong. And so it's a good idea to look at a website to determine whether or not the percentages are appropriate. One such website is BizMiner, BIZMINER.com, BizMiner.com. When looking down the income statement, focus on things like car and truck expenses, contract labor that may indicate the necessity of issuing 1099s, pension and profit sharing plans to be sure that the owner's pension and profit sharing are not included in that, or things like deductible meals and entertainment, making sure that the client indicates that they have the proper documentation for that. You know, if you only have a 1099 income that's come from one source, it's a one-time deal, you may not actually need to file Schedule C. When you're looking at Schedule C, make sure that the interviewer documents whether or not the taxpayer kept books and records as required, that they've in fact demonstrated or told the preparer that they have support for travel and entertainment, that they have a mileage log. Address those issues of the 1099 questions. And finally, we come to QuickBooks. You know, oftentimes preparers will take a QuickBooks income statement and just transcribe it onto a tax return. Well, that's not such a good idea, because if you have a taxpayer that is a cash basis taxpayer, QuickBooks typically records everything using the accrual basis of accounting. Well, some taxpayers will try to print out a cash basis financial statement off of QuickBooks. And oftentimes these financial statements are just bogus, because QuickBooks assumes that a user understands the accounts receivable and the inventory and the accounts payable modules. And most clients, at least most of our clients anyway, don't really understand how to use those, or don't use those completely correctly. As a result, using the automatic conversion from accrual to cash basis using QuickBooks is not a good thing. It's important to get the right things off of QuickBooks. First of all, we don't want to see the accrual to cash conversion done by QuickBooks. We would rather do that manually ourselves, because then we know it's done right. And when you do that, you're going to need to see a balance sheet, which in and of itself is an interesting adventure for many of these clients. So what we ask our clients to bring us is a regular accrual income statement as QuickBooks prints it out, and then also bring us a copy of the accompanying balance sheet at the end of the year. We also ask for a balance sheet at the beginning of the year, as of January 1. Well, if we've been doing the client for years, you think, well, we've already got that, don't we, from the prior year? We do, but remember that the beginning balance sheet from QuickBooks oftentimes doesn't equal the ending balance sheet from the prior year's work papers. And the reason for that is that clients go in and correct things, and QuickBooks makes adjustments, and things happen. And as a result, there may be things that ran through and never got adjusted properly. So we're going to want to see a January 1 balance sheet, a December 31st balance sheet, and of course the income statement. And then we'll do our adjustment and review the balance sheet for some interesting stuff. You know, negative cash, negative inventory, those sorts of things should bring your attention. And of course, under Circular 230, we're required to make inquiries and look at this stuff, and if it looks bogus, we'll make some adjustments and make it right. When we're looking at Schedule C, we should look at wages and ask the client whether or not they've got the kids and the spouse tucked in there, and then try to tie it to a 941 or the 940. For interest expense, ask about whether or not the credit card interest that's been used for the business has been included there. And we may wish to get those 1098 forms out on home equity and allocate a portion of that interest to the Schedule C if, in fact, the funds on the refi were used for the business itself. Well, we get down to Schedule C, Office and Home, and line 30. Very important, that 8829 form where we do the business expenses for our home. There's a great publication on that called Publication 587 that talks about business use of home. And of course, we want to consider the simplified method, the $5 per square foot, maximum of 300 square foot. Of course, there's some great advantages to that, although we've got to keep track of the years in which we use it, because in years in which we elect the simplified method, we don't depreciate the house. And later on, if they sell the house, well, we may have a recapture of depreciation, but not for those years in which we use the simplified method. There's a great worksheet in Pub 587 for calculating the deduction for business use of home office. Well, we all know that depreciation and capitalization has undergone some tremendous changes in the last year. We've got some brand new regulations that will affect us for the year 2014. And yet in 2015, we have, in RevProc 2015-20, we have a brand new interpretation of those regulations. In 2014 and early 2015, many commentators were saying that just about everyone that's filed a Schedule C or a Schedule F was going to end up having to file a Form 3115. Fortunately, in RevProc 2015-20, this is no longer going to be a necessity. So we're able to do the adoption of the partial asset disposition rules in a prospective manner, meaning that in most cases, we won't have to file a Form 3115. There are some issues in these depreciation and capitalization regs that we're going to have to look at. Of particular concern are supplies, the whole issue of incidental versus non-incidental, the issue of acquisition costs and facilitative costs when we buy assets, and then determining whether something is a betterment or a repair. So with the depreciation and capitalization new regs, there are some areas of concerns. We're concerned about supplies, incidental versus non-incidental. We're also concerned about acquisition cost, facilitative cost, and that occur when we buy a new asset. And of course, there's always that issue of betterments versus repairs. So we're going to want to make sure that when we look at the client's work papers and their support, that in fact they've addressed these issues. There's also a focus of repairs and supplies and maintenance on the return, so we know that the Internal Revenue Service will be looking at these areas. There are many different elections that are necessary in most cases where you have depreciation in a return, so we want to make sure that these elections are taken care of. For example, the $5,000 and $500 de minimis supplies elections, and perhaps the small building 2% rule. In depreciation, there is some concerns that we need to look at. Personal versus business use, for example. There's that Section 280F recapture that occurs when we get to a vehicle that's used for under 50% business. And, of course, that reverts it back to straight line and may recapture the Section 179. In Section 179, there's a whole new issue this year for 2014. In prior years, you could make an election and then later on change it. You could amend the return and just change the election. Well, starting in 2014, it's no longer possible to change your election amount for Section 179 after you've chosen. So it's very important that we choose carefully and make sure that those choices are appropriately considered. Now, the issue about standard mileage, of course, this is something that many times clients prefer to take the standard mileage instead of taking the actual, and this is great, except that when you go to turn in a car or sell that car, the standard mileage does impact the basis of the car. In fact, it affects it to the extent of about 23 cents per mile. Some other areas of concerns with Schedule C include startup cost, whether they have been appropriately identified. Very often a new client will come in and they've just started a business and, well, there's nothing shown on those QuickBooks financial statements for startup costs. This could cause a real problem later on because, well, what are startup costs? They are the costs that are incurred before the business is actually open for business. And that's an issue. You know, when is open for business? Is it the grand opening? Is it when we first possibly could take money in on the cash register? These are issues that need to be addressed before an IRS auditor is looking at it. And, of course, there's that whole issue of amortization of startup costs. We're allowed a $5,000 deduction up to $50,000 worth, and then over $50,000, that $5,000 deduction in the first year is reduced dollar for dollar. There's the whole issue of abandonment of startup costs, and then the issue of what do we do about costs where they thought about starting a business, but they didn't really complete starting it. A lot of issues in loss returns, where you have a Schedule C with a loss, center around hobby losses. Very often the IRS will look at multi-level marketing or things that involve horses or boats or social marketing and say these are just hobby losses. So it's important that we look at the 9 points that determine whether or not something is a hobby loss or whether it is a for-profit motive. And we've shown these on the screen to you. There's a new case that everyone needs to be aware of, the Bogue case. In this case, the Court of Appeals affirmed the tax court in holding that an independent contractor and property renovator couldn't claim deductions from mileage out to his different clients because he couldn't establish that his home was his office and center of operations. So they called those mileage expenses commuting. There was a similar result in Saunders, again concluding that a construction worker's expenses for travel to different work sites were personal expenses in the order of commuting. So very important that we establish in this sort of situation where we're going to have somebody working from their home base that there is a home office. Section 274D is one of those code sections that causes a lot of problems with clients because they just don't keep good records. Well, here's a new case, the Jones case that came out in 2014, in which case the failure to maintain complete and accurate records and a failure to produce them at audit subjected the taxpayer to a charge of fraud with an intent to evade. Now, no doubt, Jones must have given the auditor some attitude because this is certainly a very drastic conclusion, but one nevertheless that we need to be aware of when dealing with clients that may have less than perfect documentation. Another thing that we should always impress upon clients is that the proof of payment alone does not a deduction make. You've got to be able to prove the character of the payment, in other words, personal versus business. So, Section 274D expenses being subject to abuse, things like travel, entertainment, gifts, and whatnot, it's very important that we know you can't just use the Cohen rule. You've got to have the amount, the time, place, business purpose, and business relationship. Well, even that mythical log that clients should be keeping. In any case, it's important to point out to them that in IRS Publication 463, there are some good tips on how to keep the proper records. Now, we always ask our clients whether they have those records, and we provide them with a table right out of the Publication 463 that you see here on your screen. And, of course, they either have to answer yes or no, and if they answer no, well, then we have some discussions about the importance of maintaining proper business records. Most of the disallowances that occur in business returns center on the fact that they just haven't kept the proper records and they can't prove it. So we don't want our clients to get caught in that department. Well, we've moved down here through the income, and we're down here now to talking about capital gain. There's some issues that we ought to review in Schedule D, capital gain. The whole issue becomes whether or not we need to complete that Form 8949, the detail that supports Schedule D. Then we come up with issues regarding missing basis or incorrect totals on brokerage 1099s. Sometimes we assume that the brokerage totals are correct, but it's very interesting to look at the detail. They'll have a subtotal, and that subtotal does not include amounts where maybe they just don't have basis. And so if a preparer just picks up these subtotals and runs with them and doesn't look back to see that amounts are omitted or missing, you certainly could get a very messed up Schedule D. There's the whole issue of qualified small business stock. That's Section 1202. You remember what Section 1202 is. That's the schedules. That's a C corporation stock where the holder is the original issue, and they meet certain business requirements in terms of being an active business, and you're able to exclude anywhere from 50 to 100% of the gain on this sort of stock. There's also the accompanying Section 1244. Now, this applies not only for C corporations, but also S corporations, again, up to $100 of ordinary loss write-off. Then there's the Section 1245, which allows someone who has a small business stock to actually roll over the gain on the sale of the stock into a new small business within 60 days. There's, of course, the Section 1250 recapture, which on the sale of real estate, Section 1250 property, is subject to a tax. On real estate, it's no more than 25%. On Section 1245 recapture, it comes in at ordinary income. There's the issue of on collectibles, taxed at 28%. The typical situation here is someone who is invested in gold coins or some sort of antique. And then we have this issue of what happens with separate property when a spouse dies. And if there was a capital loss carryover which came from that separate property, that will be lost the year after the spouse is deceased. We have to, of course, report the sale of principal residences. Many times taxpayers don't think they have to pay taxes on it, so they don't even mention it to the tax preparer, and it's never entered on Schedule D. Unbeknownst to them, the trust company or escrow agent has sent a 1099 to the Internal Revenue Service. Well, we end up with situations where clients get notices about why they didn't report the sale of their personal residence. And, of course, the IRS thinks it's just a sale of a rental property or something like that, and they want the profit to be taxed on the Schedule D. So important that we ask clients about their addresses. If it's changed, if they've sold their house, well, then we should reflect that on the Schedule D as a Section 121. Of course, the gain up to $500,000 excluded if we have the 2 out of 5 rule met. There's a provision in the Internal Revenue Code to exclude the losses that occur as a result of wash sales. That's where you sell a security at a loss, then you repurchase it within 30 days. Short sales, well, if we sell a security short, in other words, we sell a security before we actually own the security, the gain or loss is shown when it's closed out. Now, for gains, we use the trade date, but for losses, we use the settlement date. This could cause a dramatic difference in how things are reported if these events occur near year end. Now, for puts and calls like options, it's a whole different thing. We need to treat those just like regular Schedule D transactions. And then we come to something called a Section 1256 contracts. These are oftentimes referred to as straddles. They're often open at year end, and so we treat them as if they're sold as year end and report 60% as long-term capital gain and 40% as short-term. Well, Box 12, Code V, indicates on the W-2 that there's been a stock option, and so it's important that we understand how to treat those things. There are really two of them, two kinds. There's an incentive stock option and something called the ESPP plan, an employee stock purchase programs. Well, the income should already be in the W-2 for the transaction itself. However, the sales price needs to be reflected on a Schedule D. Now, sometimes what will happen is they will exercise these stock options and then hang on to the stock. Well, you're going to have to report the purchase of the stock and sale of the stock as a gain on the Schedule D for a closed transaction. For an open transaction, it might be a little bit different. Well, the Schedule D should show the gross and the basis, no gain or loss, for what they call a cashless exercise. If in fact the stock is held, well, there may be gain or loss on the subsequent change. In some instances, we'll encounter a 1031 exchange, a tax-free exchange, sometimes called a Starker exchange. Very important that we not file a tax return while a delayed exchange is in process. Of course, there are timing rules, the replacement property having to be identified within 45 days, but more importantly, that the replacement property has to be received within 180 days. And so it's important that a trade not be left open and a tax return filed. Put a return on extension. Now let's explore another important form, the Form 4797. Now this is an important form because it reflects the sale of property used in a business. This would be depreciable property, could be oil and gas, geothermal, mineral property. It even includes the reporting of the recapture of Section 179. Well, we're going to make sure that if we buy or sell a business that we also include a Form 8594. This has to be filed by both the buyer and the seller of a business, and it's very important that it reflect how assets that were purchased or sold were classified according to various categories. Well, we've worked our way all the way down to Schedule E. Now, let's talk about Schedule E. It's oftentimes needed, even if the property is held as an LLC, if that LLC is a single-member LLC. It's oftentimes used in the case where the property is held in a grantor trust. Some new changes that you're going to see on page 1 include the indication of what kind of property is actually held. And you'll see that they ask the questions about the Form 1099. Again, very important. Many of our rental property clients don't perceive the need to send 1099s to tradesmen or other people that work for them for whom they pay more than $600 cumulatively in a year. Also note that there's something new called a QJV, which is a qualified joint venture. This is a situation in which you have a husband and a wife that own a property jointly, and they elect to file. Important that we be aware of the passive and at-risk tests. To deduct losses, you have to not only be at risk, but you have to show material participation. And for material participation, there are 7 tests that are outlined in Pub 925. We've shown them here on the screen so that you can take a look at them. It's a good idea to show these tests to your client and see whether or not they have passed these tests in one or more areas. And what we do is print out these little tests, ask them to identify the areas in which they can, in fact, meet the material participation, initial it, and then give it to us. This goes into the work papers and gives us the kinds of documentation to show that we've addressed the issue of material participation. With respect to at-risk, it's really pretty easy, as shown in Pub 925, as you'll see here on the screen. One of the things that is very important and is a decision that can be made by a taxpayer is to do something called grouping. Let's suppose we have some properties that, well, we can't just show the material participation in, and other properties that, well, we can. Maybe what we can do is group those properties together as different activities. And so the grouping rules exist, as outlined in Publication 925, to allow us to take several properties and put them together in order to meet the material participation rules. On Pub 925, there's a printout here showing how grouping is done, and this is out of the publication directly. You'll also notice that there's a disclosure requirement that indicates that after 2010, it's very important that groupings be shown or disclosed on the tax return. You see, typically rentals are passive. There's an exception, of course, for $25,000 a loss, but that begins to phase out when your modified adjusted gross income goes above $100,000, and it's totally done by the time you're at $150,000. Now, real estate professionals meet this requirement and that it not be passive if more than 50% of their personal services are real estate related, and they have a 750-hour material participation rule. However, if they're working for someone or it's any business that they're trying to use the time invested in that business to meet the material participation rules, it's important that they be at least a 5% owner of that business. Now, just because you've met the real estate professional rules doesn't mean that grouping isn't important. In fact, if you can't show that you group all of your properties together, you may be in a situation in which they're going to look for material participation of 500 hours in each of the ungrouped properties. Let's go to page 2 of Schedule E and take a look at K1s. You know, sometimes a K1 comes in and has one figure, but it really represents several different activities aggregated together. It's important that when we review a tax return, we look at the materials that accompanied the K1. There may be indication there that there were several different activities that have been aggregated into the figures that appear in the K1. So we'll want to make sure we take a look at that. Another thing that oftentimes happens with K1s is you get errors. If you have an error in a K1, or if you don't receive a K1 after repeated requests, you'll want to file a Form 8082. This is a very important form to file. There have been several cases. The last one in 2014 was regarding a Doc Kumar, who basically, well, he didn't think he had to file, even though he got a K1, because he'd been separated from his group practice, and he didn't think he owed any taxes on the amount of income that was allocated to him. Now, he hadn't gotten any of the cash, he'd just gotten income allocated to him on a K1. So he went ahead and didn't include the K1. The tax court concluded that it was in fact taxable to him, regardless of the fact that he had not had any participation in the practice and he hadn't received any income from it. The fact that he was an owner and that it had been allocated to him on a K1 was enough for them. So for our purposes, what we're going to want to do is make sure that if we have something like a case like Kumar, or a situation in which a K1 is inaccurate, that we in fact file a Form 8082, because it shifts the burden of proof. And we'll want to look for that, especially where we're preparing returns where there's some controversy with respect to a partnership or an S corporation. In a partnership, if you have unreimbursed partners' expenses, you can take them. They're put on a separate line on the return. On the Schedule E, you're going to show the partnership identifying number, the partnership name with a dash, and the initials UPE for unreimbursed partners' expenses. Remember, though, that it's important to have a documentation of what those expenses are, that it be something that's outlined in the partnership agreement, or that there's a long-standing practice. The principal case in this area is the Hines case, Hines, a Glendale, California entertainment lawyer who failed to account for his expenses in a legitimate fashion. Now, how about shareholders' expenses for an S corporation shareholder? Well, unfortunately, the only kind of expenses that a shareholder can have and deduct on his return would be expenses that he incurs as an employee, which would be reflected not on the Schedule E, but on Form 2106 employee business expenses. So for shareholders' expenses, there's no way to show them on Schedule E, only employee business expenses. If those kinds of expenses exist, it makes sense to record them on the corporate books as an advance or an equity investment in the corporation, reflecting those expenses onto the corporation, increasing the equity of the shareholder and thus expensing those expenses. The one exception to not showing expenses related to shareholders on Schedule E has to do with interest expense on a loan for the purchase of stock. That's allowed as an ordinary loss deduction and can be offset on Schedule E. If we have a foreign partnership, well, a foreign partnership does cause us some problems if the ownership is over 10%. You'll have to file a Form 8865. Oftentimes our tax software is pretty good at tracking suspended passive losses, but it's important to note that if we get a new client or if we haven't been keeping track of this, it's important to look for that and make sure that that's done appropriately. There's a term called composite returns, and these are returns in which the partnership or the S corporation has actually filed a return on behalf of the partner for many of those little states and little amounts that maybe you don't feel like you want to file an individual return for. So this is a kind of an administrative alternative to filing a separate return in that state, and it oftentimes reduces the burden. Well, we've gone through the income. Now it's time to focus on the adjustments. On line 23, of course, we have educator expenses. This is back for this year. It's been reinstated, $250. The amounts that are not claimed there, well, the instructions to the form say take it to Form 2106. But in the case of an educator who's expending money on behalf of a government or a nonprofit school, these sorts of expenses do qualify for deduction as charitable contributions where they're not limited by the 2% limitation. You'll see that on line 26 we have Form 3903, the moving expenses deduction. Make sure that form is there if you see on a W-2 a box 12P amount. Let's take a look at what happens with a Form 1099 SA. Now these have to do with distributions from an HSA or Archer MSA. And if those things happen, you've got a gross distribution, that's going to be taxable income unless we spent an equivalent amount on qualified medical expenses. If you see something, one of those, or you also see a 5498 where you see a contributions, you're going to want to make sure that these are appropriately reported on the returns. Well, now let's take a look at line 28 and line 32, where we get to deduct amounts for pensions. Here on the screen you see the deduction amounts that are allowed for an IRA, depending, of course, upon the marital status and the adjusted gross income. Now, Roth contributions are also limited, and again, there's a little bit higher limit there. For 2014, the IRS has told us they're not going to enforce the results of a court case in which it was shown that you only get one IRA transfer or rollover per year. You, in fact, can do a trustee to trustee, an unlimited number. But if the trustee goes to the taxpayer, then to another trustee, there's only one allowed per year total. For simples and qualified plans, well, a simple contribution could be up to $12,500, but over 50 you get to add another $2,500. SEP IRAs can be up to 25% of the employee's compensation. There's a limit in 2014 of up to $52,000. Now, the participant can do a $17,500 max, but the corporation or the company, the employer, can contribute the balance for a total contribution under the Section 415 limit of up to $52,000. For a regular 401k, of course, the limit is $17,500 with an additional $5,000 catch-up for those over 50. For a solo 401k, an individual can put in $12,500 plus a $5,000 catch-up for the over 50, but remember that an individual employer can bring you up to the total contribution maximum under Section 415, so it's possible to get a much larger contribution. The maximum Section 415 limit, as shown on the screen here, is $52,000 plus the $5,500 catch-up, which this really applies to all plans. But again, it means not that the employee is making the contribution, but the employer is. Well, let's take a look now at the self-employed health insurance deduction. For self-employed health insurance, it's got to either be paid by the business or reimbursed. And so the business income that we have must be larger than the premiums in order to allow for a self-employed health insurance deduction. Now, if it's reimbursed by an S-Corp, it only works if you have no more than one W-2, because under the Affordable Care Act, there's a limitation on the way businesses can pay for individual plans, and this is new for 2014. And plans that are paying for private insurance premiums, for employees or for officers, it doesn't matter. Remember, there's that $100 a day penalty. This excise tax is payable on Form 8928. However, there's an exception available, and the IRS has announced that they don't plan on enforcing the penalty, assuming that in 2015 these problems are resolved. Well, we come all the way down to line 35, where we can talk about the domestic production activities deduction. Now, this is one that's missed a lot, where you have a Schedule C for someone that's, let's say, an artist, or let's say they make some little manufacturing thing, or they're maybe have a Schedule F, they're a farmer. And this little domestic production activities deduction, which is 9%, limited by 50% of your W-2 expense, is oftentimes missed, and something that we want to make sure we don't overlook. Well, let's go to page 2 of the return, the 1040, and focus on itemized deductions. This is what our Schedule A looks like for itemized deductions this year, and there have been some changes that we need to be aware of. For example, for itemized deductions for medical, there's now a 10% floor, except if one of the spouses is 65 or older, in which case it reverts back to the 7.5% limitation. But don't overlook some things for medical. For example, home health care or long-term care, transportation. But remember that if you're getting a reimbursement from an HSA or an MSA, you have to net that against the amounts. For taxes, it's important to remember that there's the sales tax and the state income tax, that one of the two, is still deductible for 2014. Remember that sales tax includes whatever amounts come off the table, plus the vehicle purchase tax. And we found that in some of the tax programs, the tax tables for the state and local taxes are not sufficient. In other words, they don't take into consideration local sales taxes that have been imposed or special sales taxes that have been imposed. So be sure you check those rates, because sometimes they're just using the state minimum sales tax as opposed to the actual sales tax for the locality in which the taxpayer resides. For real estate tax, remember, there's no limitation on the deduction of that. It's on all the properties owned. Be careful, however, you have to be able to show that you have at least equitable ownership. Interest deductions, big itemized deduction. In fact, probably the fundamental deduction that's going to be shown on most taxpayers' 1040s Schedule A. Well, there's all different kinds, and we have to remember that not all interest ends up on the mortgage interest line. There might be interest that has to be capitalized, or there might be student loan interest, or business interest, or investment interest. Unfortunately, some interest may not be deductible if it's personal or passive activity interest. Even though it might come to you on a Form 1098, we should do some interest tracing. Where did that interest go? Now, of course, the first $100,000 borrowed on a home equity line can be classified as home mortgage interest, regardless. The problem is that maybe it would do better to take some of that interest expense and classify it over on Schedule F or on Schedule C. It's important that the interest be recorded. There's a very unfortunate tax case this last year, the Francis case, in which a parent made a loan to the child but for the purchase of a home, but forgot to record an equity interest or a mortgage against or a lien against the house, and as a result, the IRS found that the interest was not deductible as mortgage interest. Unfortunately, the parent had to pick up the income, but the child got no deduction for it. Always look to make sure whether or not any of the monies borrowed out are invested in some sort of business or something. Remember that points are only for the purchase or improvement, and even if it's a refi, if they've drawn out more money and and invested it in the house, they're going to get to deduct at least a portion of the points. But we always have the option to amortize points. And this sometimes is very valuable in a case where you have a new homeowner. They buy a house late in the year. They're not going to be able to deduct the mortgage interest. They're going to be under standard deduction, so you should elect to amortize those points, and then later on they'll refi and they'll get to deduct the balance or the vast majority of those points. Now, reverse mortgages. There were several court cases this last year that showed that interest on reverse mortgages is not deductible. It's only deductible when the reverse mortgage is actually paid off. Keep in mind, too, that only 2 homes can have the interest on them deducted. If you have more than 1 home, it's possible to deduct the interest on one home this one year and another home another year. You're not stuck determining for a permanent basis which homes you're going to deduct. Remember, too, that if you have a house that's under construction, the construction loans, you have up to 24 months of interest that can be deducted as opposed to being capitalized. One important point is that boat and RV interest, which can qualify as home mortgage interest, is not deductible for as home mortgage interest in the determination for AMT. Let's talk about itemized deductions for contributions. This includes charities, government, nonprofit schools, and whatnot. Be very cautious of foreign charities. Make sure that the charities you're looking at are in Pub 78. You may also want to be able to check the W-2 detail of the paycheck stub for amounts that were withheld from the paycheck. Political contributions and raffles and dues to lodges and whatnot are not deductible as charity. Sometimes our clients have another opinion. And then, of course, we ask the taxpayer whether they got anything in return. We want to look for the statement on the receipts and make sure that these receipts are properly maintained by the client. There was a case where a client did not maintain their receipts, or they lost the receipts, and their deduction under audit was denied, even though they went and got a replacement receipt. That's the Gomez case. Remember that if it's more than $250, you have to have a written statement. Well, Pub 1771 gives some very good advice about the kinds of substantiation and disclosure requirements that are required. And we put on the screen here, you might wish to review this. Make sure that it has the statement that no goods or services were provided by the organization in return for the contribution. There's a very bad court case of the Durdens. They were debarred from taking a $25,000 contribution because they did not have the proper statement on their contribution receipt, and they were unable to prove that they had that statement at the time that return was filed. Remember that for non-cash, the documentation has to include the name, date, description, fair market value, and the method used to value it. Very oftentimes clients come in with these little door tags, and they don't even know the date of the contribution. That's just not sufficient when they're going to get audited. And remember, too, that if it's over $5,000 in value, even in aggregate, they must have an appraisal. There was a court case last year in which a son tried to take the donation of all of the inherited value of his parents' household that he contributed upon their death, and he tried to take $28,000. Well, he did not have a very good detailed list, and he didn't have an appraisal. And the court said the value of these goods was over $5,000. It's a group of similar goods, household goods, and as a result, an appraisal was required. Here's a very unfortunate case of Joseph and Shirley Muhammad, who were denied a claim for donating millions of dollars worth of property because they didn't have proper appraisals. They had taken a self-assessed value of $18.5 million, and an independent appraisal at the audit showed that it was actually worth more. But the fact that he didn't have the proper appraisal, he was not allowed the deduction and not able to meet that later or after the fact. Here you see an example of a little donation tax receipt, and you can tell right here that there's a real problem with this thing because obviously it has no detail and probably puts the taxpayer in great jeopardy by not having a detail of what actually was donated. Let's look at miscellaneous itemized deductions, and here you see some job expenses and tax preparation fees and other kinds of expenses. Remember, education is deductible except if it qualifies the taxpayer for a new trade or business. Remember that IRA fees, they have to be paid outside the IRA. IRA fees that are deducted out of the balance of the IRA, not deductible. On line 20, we come to casualty and theft losses. Remember, you're going to have to file a Form 4684, and there's a good publication that'll talk about that, Publication 584. Line 28 has other miscellaneous deductions. We've listed a few of them here. These are things like casualty and theft losses from income-producing property, again, much different than just a personal casualty loss. Gambling losses to the extent of gambling winnings. Here's one, impairment-related work expenses for persons with disabilities. This, for example, could include a hearing aid or batteries for a hearing aid or a special chair for someone with a back problem. Losses from Ponzi-type investment schemes are deducted here as opposed to being a theft or casualty loss. And, of course, unrecovered investments in annuities which are completely paid off. Publication 529 has a great list of other deductions that are deductible under the other deductions area, miscellaneous deductions, both those that are subject to the 2% and those that are not. Finally, we come down to the computation of tax, and let's point something out here. There's Form 8814. This form is used to include the children's interest and dividends in the parent's return. Well, it sounds like a great idea, except if the parent may be subject to net investment income tax, it may be a bad idea, because what happens is that income of the child will be included in the net investment income tax calculation. So it's better maybe to file a child's return and use Form 8815. Very occasionally, you'll see a tax on a lump sum distribution, and these, again, only for qualified plans for participants born before 1936. It's very rare, but occasionally you see it. Now, when we get down to credits, be aware of the fact that for foreign tax credits, you don't need the Form 1116 if the total is less than $600 for married filing joint. For credit for child and dependent care expenses, we have a maximum expenses of $3,000 per child, maximum of $6,000. Now, the employer can do it tax-free, and they get up to $5,000, so it might actually be a little bit better to run that through a Section 125 plan. If you have that and you see it on Box 10 of the W-2, make sure you have the Form 2441 attached. On line 50, we have education credits, and that's both the American Opportunity and the Lifetime Learning credits. And these work for both dependents and the taxpayer. On line 53, we have the residential energy credits, which comes off of Form 5695. And take a look at that form. It's got some fascinating credits here for solar water heating, solar electric, even geothermal. And increasingly, clients will find that they can save money by installing some of these systems. Well, finally, we come down here to the healthcare and the ACA. And basically, we're going to be dealing with two lines on the returns here. Line 46, where if they've gotten an advance premium tax credit, they may have to repay some of it. And, of course, line 61, where we're going to indicate whether or not we have full year coverage, and if we don't, whether or not we owe penalty. So here's a little flowchart that kind of describes the way that the ACA works for 2014. For many of our clients, all we'll have to do is say, were you covered by insurance all year? Remember, the preparer is not required, nor should they really probably, do any sort of auditing on this. You just have to ask the question, and if the client says they were covered, that's good enough, and that meets all the requirements of the Circular 230. Now, if we have insurance from the marketplace, and we will receive something called a Form 1095A. If they don't bring it in, then that's an open item. If they do bring it in, depending upon their income, they may be subject to a credit. They may get a credit. But remember, that credit phases out at 4 times the federal poverty level. And 4 times the federal poverty level for married with 2 kids is about $96,000. Then if it looks like they weren't covered all year, there may be an exception. And if there is no exception, well, then they'll have a penalty. But oftentimes getting a penalty may be involved with getting a certificate number from the health insurance marketplace. So if they get the 1095A, they might qualify for a credit. Here you see the actual listing here, and you saw for a family of 4, below about $95,000 or so, they may in fact qualify for a credit. Here's the 1095 form itself, and this information will be input into the return. Here's the new form where the premium tax credit is calculated, the Form 8962. Make sure that Part 3 is calculated, where if there's been any excess advance payment, If they have to pay it back, they have to indicate that at Part 3. And that'll end up on line 46, as we noticed. Now let's go down to line 61. Here is an organizer that we use in our firm to ask people whether or not they are covered by Obamacare or some sort of insurance during the year. And if so, that's all we ask. They say yes, we're done. Here's another questionnaire where they ask some questions about whether or not they purchased it from the marketplace. Again, identifying whether or not they should have a Form 1095-A and maybe whether or not they get a credit. So how will the IRS know if someone didn't have health coverage in 2014? And the answer is they really won't. The IRS is relying on taxpayer reporting in this year, and they're not expecting to have any massive database or any kind of this thing that will be able to pinpoint which taxpayers have coverage and which don't. It's just basically self-reporting for 2014. Now 2015, everything changes. Well, what are the issues that we're going to deal with for 2014 returns? First of all, for the individual returns, we really have to deal with whether or not the client was required to have insurance. That's the number one thing. And whether or not they were covered by any sort of qualifying plan, or whether they qualify for a credit, or if they don't, whether there's going to have a penalty for failure to have coverage. For business returns, the big issues that we have to deal with in 2014 are going to be a possible health care credit. Now remember, they changed the rules on that. You don't get the health care credit unless the insurance was purchased through the shop exchange. So you're going to see a dramatic drop-off in the number of clients that are qualified for that health care credit. And then, of course, there's this $100 a day penalty for paying for a private plan out of a business. Businesses are not supposed to pay for private plans. If you're not aware of this penalty or not, this comes as a shock to you, there's a lot of information on the healthcare.gov website and also the IRS website and the Department of Labor website. This has been a big topic. Now, the IRS has told us that they're planning on accepting most people from this penalty this year. However, that's conditional upon those taxpayers taking steps to make sure that the situation is resolved in 2015. And finally, there's the issue of whether or not your client is considered to be a large employer, in which case they may be required to offer coverage in 2015. Well, we're talking mostly about the 1040, so let's go back here to some of the other taxes. Well, of course, we have the Form 5329, which deals with additional taxes on IRAs or other qualified plans where there's an early distribution. But be sure to check out the exceptions to the penalty. There's a lot of them. Those clients that have people that are working for them in the house, caretakers or people working in the house as home workers, household employees, well, they may have to file a Schedule H. Any domestic worker or child care provider for which more than $1,800 is paid should be given a W-2. It's important that you ask about this because the penalties for failure to file that get relatively substantial. And here's one that maybe you haven't thought about. Back in 2008, you may recall, there was a new first-time homebuyer credit. But this credit was actually just an interest-free loan and had to be paid back in 15 years, over 15 years, in 15 equal installments. Well, the credits in 2009 to 2011, they didn't have to be paid back as long as you held the house for a principal residence for 3 years. So what we want to determine for the 2008 returns that had that credit, if the house has been sold, there's an acceleration of the amounts that are due if their house was sold not at a loss. So we have a Form 5405. Again, if we've seen a change in address or we've seen a home sale, we need to find out when that house was purchased, and if it was purchased in 2008, then we can actually determine whether a credit was issued by going to the IRS website where there's a first-time homebuyer credit lookup. So last year, we had to deal with this Form 8959, the additional 0.9% Medicare credit, and also the brand new Form 8960, which had to do with the net investment income tax, the NIIT tax. Well, these are the same for this year. There have been some clarifications. Remember that if it isn't earned income, it's probably net investment income. There's one big exception to that, and that's K1 coming from S corporations. And there is some debate about how rental income could be exempt from the net investment income tax, but really it requires it to be a trader business. The chances are that the exceptions to that are probably few and far between. Well, if you do have a situation in which you have rental losses and you have rental income, remember that the net investment income tax is very selective about the way it ignores losses and picks up income on rentals. So the IRS has allowed us to do a one-time election to regroup, allowing us to match maybe some of those passive losses with passive income and in the rental area, and maybe even avoid the net investment income tax. But it's a one-time thing, and it's available for 2013 for everyone, but in 2014 only if we didn't file 2013 net investment income tax. Finally, we come down to the bottom line here, and some things that are important that we be aware of here is whether or not we have any credits. For example, the credit for federal taxes paid for fuels. This really only applies in a case where it's used for farming or fishing. There's also a credit from a Form 2439, which will come from a real estate investment trust. Very unusual, but be on the lookout for it if your client has a REIT. There's a lot of special situations. Here are just a few of them. Be aware of the fact that if you have someone in the clergy, or there's a situation of bankruptcy or oil and gas or working interests or foreign income exclusion, these are special cases that are going to require some special attention. Well, are we ready for this? Taxes are pretty much a moving target, and so what we're trying to do is our very best. And doing a good review is part of an overall program of quality control within a firm. We want to be sure that we document what we do in the review process. Take notes, clear notes, and make sure that our issues are identified. We want to show the resolution of notes, never leave a note unresolved. And look at the review as a way to train the preparer so that they understand more of the complexities and some of the issues that are involved in the tax return preparation. It's not a good idea to come up with 100 review points. We should be encouraging our preparers to clear as many of these items as they can before it gets to you as a reviewer. So documentation is very, very important. We conclude the seminar with a funny little book that's out there called Taxes Can Be Fun and Sexy. And you show that to the average client, they roll their eyes backwards. But we think, yes, in fact, taxes really can be fun. And so we say to everyone, we hope that this seminar has been helpful in identifying some of the issues that come in reviewing an individual tax return. So now, for those of you that want to get your CPE continuing education credit, we present a quiz. For those of you that want CPE credit, here's a following quiz. Each one of the questions will be displayed for approximately 15 to 20 seconds. Write down the correct answer and submit that for CPE credit. So submit your answers for CPE credit, a score of 75 or better, and you receive 2 hours
100 minutes of CPE credit.